Welcome back to the deep dive. We hear so much about company profits, right? Big revenues, earnings per share. It's always in the headlines.
hmm
But what if those numbers, what if they don't really tell the whole story?
That's often the case.
Yeah, like there's this other language, a kind of secret language spoken by the actual money, the dollars and cents flowing in and out.
Right, the real cash.
Exactly, the language that reveals a company's true financial pulse. So today we're diving into that. We're going to dissect the cash flow statement.
It's a crucial one, often overlooked maybe.
I think so. Think of it as our financial magnifying glass for today's deep dive.
Yeah, that's a great way to put it. Because, the profit and loss statement, the P&L, it shows what a company earned based on accounting rules.
Right, the rules.
But the cash flow statement, it cuts through all that. It strips away things like depreciation, other non-cash items, and just shows you the actual tangible movement of cash.
Money in, money out. Simple as that.
Pretty much. It's the difference between, saying you made money on paper and actually having enough cash in the bank.
Yeah.
Cash to pay the bills, invest, pay back owners.
Got it. So our mission today.
Our mission is to unpack this.
Huh.
What is a cash flow statement really?
Mm.
Why does it matter so much, arguably more than profit sometimes? And how do you read the key parts to see what's really going on?
Okay, let's start the investigation then. Our sources define it pretty clearly. It shows money actually coming into and going out of a company in a particular period. Cash inflows and outflows. It feels like the ultimate reality check. You can't spend profit if it's not cash, right? Can't pay salaries with IOUs based on future earnings.
Exactly. And that's why it's just so critical, especially if you're looking beyond the headlines.
Right.
I mean, a company can look profitable, maybe for years even, but still crash and burn if it doesn't manage its cash.
Happens all the time, doesn't it? Like with fast-growing startups.
Absolutely. That's a classic example. They might be scaling like crazy, sales going through the roof.
That's great on paper.
But they're burning through cash faster than they can collect it, or faster than they can raise it from investors. So understanding this statement, it lets you see if they have the liquidity, the actual funds to operate day to day.
To invest and pay people back.
Precisely. Invest in growth, pay back debt, give dividends to shareholders. It really reveals the quality of their earnings. Is it real cash profit?
Quality of earnings. I like that phrase. Okay, so this cash story isn't just one big, messy pile of money, is it?
No, thankfully not.
Our sources say it's organized, structured into three distinct areas, three pillars of cash flow, you could say.
That's right. 3 main buckets. And they aren't just random categories. Each one tells a really specific, vital part of the company's story.
Different chapters in the cash book.
Exactly. Think of them like different lenses. Each gives you a unique view on how the company handles its cash. And by looking at them one by one and then seeing how they, interact, you get a much deeper picture of how efficient they are,
Yes.
where they're headed strategically, and frankly, how resilient they are financially.
All right, let's jump into the first pillar then. Cash flow from operations. This sounds like the real core, the heartbeat of the business.
It absolutely is. This is all about the cash coming in and going out just from the main business activities. Selling stuff, providing services,
Keeping the lights on.
keeping the lights on, paying suppliers, paying employees, the daily grind, basically. If this part isn't generating positive cash, you really have to ask why, like immediately.
Okay, so the definition is net cash flow from operations.
That's the money generated by the sales of the company's goods or services minus the money spent on supplies, staff salaries, etc. in the period.
So give us an example, like a software company.
Sure. For a software company, this would be the cash they collect from, say, subscription fees, minus what they pay for servers, cloud hosting, developer salaries, maybe sales commissions, marketing to get customers.
Got it.
It's the purest measure of whether the core business itself is actually generating cash.
So just being positive isn't enough, right? I hear people talk about consistency. How important is that?
Oh, consistency is huge. A consistently strong, positive cash flow from operations. That signals a healthy, sustainable business. It means they can fund themselves from their own activities.
Without always needing loans or new investors.
Exactly. But if it's really volatile, bouncing up and down, even if it averages out positive, that can be a bit of a red flag.
Why is that?
Well, it could mean demand is unstable, or maybe they're bad at managing their working capital, like they aren't collecting cash from customers fast enough, or they're holding way too much inventory.
Okay.
Or maybe their business is just naturally cyclical.
Yeah.
But the point is, for someone looking closely, it's not just the number. It's the trend, the consistency.
That makes sense. What about those companies, the ones that show amazing revenue growth, but their operating cash flow just isn't keeping up? What's happening there?
Yeah. That often points back to that quality of earnings idea we mentioned.
Right.
Maybe the company's using really aggressive accounting, like booking sales on the income statement way before the cash actually comes in.
Or giving customers really long payment terms just to make the sale.
Exactly.
Yeah.
So you see high reported profits, but they aren't turning into actual cash in the bank. There's a gap.
Making them look healthier than they are cash-wise.
Potentially, yes. Now, contrast that with, say, a high-growth startup. It's actually pretty normal for them to have negative operating cash flow early on
Really? Why?
because they might be deliberately investing heavily in things like inventory, R&D,
Yeah.
or just building up accounts receivable because sales are growing so fast.
So they're spending cash now to fuel future growth.
Precisely. In that situation, negative operating cash flow might be a strategic choice, not necessarily a weakness. As long as, they have the funding coming in elsewhere, like from financing.
Okay, that distinction between strategic negative and, well, problem negative is really key. Good point. So once a company has cash from its operations, what does it do with it for the future? That sounds like the next pillar, cash flow from investment activities.
You got it. This is where the company puts its cash to work outside of the day-to-day grind, investing to grow, expand, or just manage its assets.
This is where we see their long-term game plan.
Exactly. You see their vision in action here. This section tracks both inflows and outflows related to investments.
Okay, what kind of inflows?
Well, inflows could be cash coming in from selling investments they hold in other companies like bonds or shares, what we generally call securities.
Oh,
Or maybe getting cash back when loans they've made to others are repaid, or even interest received on those loans.
and the outflows, spending the cash.
Right, the outflows are often more revealing here. This is where the company spends cash, maybe buying securities in other companies, making new loans, and, crucially, buying capital expenditures, or CapEx.
CapEx, that's the big stuff, land, buildings, equipment.
That's the one. Land, buildings, machinery, technology. This part tells you, are they expanding? Buying competitors,
Huh.
building new factories, or maybe selling off assets.
Right.
And for someone really digging in, the question isn't just if they're buying equipment, but why. Is it growth CapEx, buying new stuff to expand capacity or launch new products?
Or is it just replacing old machines?
Right, maintenance CapEx, just keeping the current business running. Getting that distinction often means looking at the footnotes in the reports, but it's critical for judging their real growth prospects.
So if a company has big negative cash flow from investing, that often means they're spending a lot. Could be good, right? Investing in the future.
Often, yes. Heavy spending here usually signals expansion, reinvestment, but what if it's consistently positive? They're bringing in cash from investing.
What would that mean? It's kind of a mixed bag. Depends on the context. For a big, mature company, maybe they're selling off divisions that don't fit anymore, streamlining things,
Okay, makes sense.
or generating cash to pay down debt or boost dividends. But it could also mean they're not finding good enough opportunities to reinvest internally, which might suggest, limited future growth.
Or worse.
Or worse, if it's a company that's clearly struggling, consistently positive investing cash flow could mean they're desperately selling assets just to stay afloat. A big red flag. Context is everything.
Wow, okay. So investing is way more nuanced than just seeing a plus or minus sign. Got it.
Okay.
Let's move to the third and final pillar, cash flow from financing activities. This sounds like it's about how they actually fund everything we've talked about.
Exactly. It's about how the company raises money capital to fund its operations and its investments. And just as important, how it pays back the people who provided that capital.
The owners and the lenders. The owners and the lenders, precisely.
Yeah.
This section shows that relationship. Cash inflows here. That's money coming in from borrowing, taking on new debt, short-term or long-term.
Okay.
Or money from issuing new shares of stock, which brings in new owners.
Mhm.
Or issuing new bonds, which is another form of debt.
And the outflows. Paying money out?
Outflows would be repaying those loans, paying back the debt,
Mm-hmm.
and a big one, paying dividends to shareholders.
Dividends. The rewards for the owners.
That's right, the return on their investment paid out in cash. So this whole section really lays bare the company's funding strategy. Are they taking on debt, selling off ownership, rewarding current owners?
So what does that strategy tell us? Is debt good or bad? Is issuing stock good or bad? How does it all connect?
Well, that's the million-dollar question, isn't it? If we
Mhm.
connect this to the bigger picture, financing choices reveal a lot about financial leverage, risk, Capital structure.
Okay.
I mean, a company that relies heavily on new debt, sure, they might have plenty of cash now, but it increases their interest payments, their financial risk, especially if interest rates go up.
Right.
On the flip side, a company constantly issuing new stock to raise cash, that can dilute the ownership stake of the existing shareholders. Their slice of the pie gets smaller.
So paying dividends or buying back shares is usually seen as a good sign.
Generally, yes. It suggests the company is financially healthy, confident, and committed to returning value to its owners. Again, context matters. A rapidly growing startup needs to raise capital, so big inflows from financing are expected, even necessary.
Whereas a mature, stable company might be expected to pay down debt and return cash.
Exactly. It shows their financial philosophy, where they are in their life cycle.
Okay, so we've walked through the daily grind of operations, the future building of investments, and the funding journey of financing. We've seen cash move through these three areas. How do we? How does the company and how do we put it all together? What's the final score?
Well, you literally add and subtract all those inflows and outflows across the three sections: operations, investing, financing. And that gives you the net increase or decrease in cash and cash equivalents for that period, say the quarter or the year.
So the change in their cash balance.
Exactly. That final net cash position and how it changes over time is incredibly important. It's the real bottom line for understanding liquidity. Can they pay their immediate bills? And solvency. Can they meet their long-term debts?
Got it. Now, beyond just that net change, I often hear analysts talk about something called free cash flow. Can you quickly break that down? Why is it such a big deal?
Oh, absolutely. Free cash flow, or FCF. It's a really powerful metric, kind of a gold standard for many investors because it connects these pillars.
How so?
Basically, FCF is the cash a company generates after it pays for its operating expenses. A&D, its essential capital expenditures, the investments needed, just to maintain or expand its existing asset base.
So operations cash minus the necessary investing cash.
That's a great way to think about it simply. Cash flow from operations minus capital expenditures. It's the cash that's genuinely free.
Free for what?
Free for the company to use however it wants, strategically. Paying down extra debt, paying dividends, buying back stock, making acquisitions, pursuing totally new opportunities. Things that aren't just keeping the lights on or replacing old gear.
Ah, I see. So a company with lots of free cash flow
Is basically a cash-generating machine.
Mm-hmm.
It signals a really healthy business with flexibility. They can fund their ambitions without constantly needing to borrow more or sell more shares.
Okay.
And this really raises an important question, doesn't it? How does understanding all this, the three pillars, FCF,
Yeah.
how does it empower you, the listener? Whether you're looking at stocks or maybe just curious about your own employer's health or the economy.
Right?
This statement, the cash flow statement, it really pulls back the curtain. It
Yeah.
shows the true financial muscle, or maybe the lack of it.
Okay, wow. That was quite the deep dive today. We started by kind of questioning those profit headlines.
Mm.
And then we defined a cash flow statement, unpacked those three key sections: operations, investment, financing, and even got into free cash flow.
Covered a lot of ground.
Yeah. So you, listening now, you really have a shortcut, a better lens to see a company's actual financial health beyond just the surface level profit numbers. So what does this all mean for you?
Well, it means you're better equipped,
Right.
right? You can be a more critical, more informed observer of business. And maybe here's a final thought to chew on.
Okay.
Using this knowledge, what might you think if you see a company that looks profitable on its income statement, but it consistently has negative cash flow from its core operations? But maybe its free cash flow looks okay because it's always selling off assets. What story does that tell?
That sounds unsustainable.
It could be. Or conversely, what about a company with fantastic operating cash flow, but its free cash flow is always low because it's pouring every spare cent into huge strategic investments?
Different story entirely. Might be a great long-term bet.
Yeah, exactly. The interplay between these numbers, the stories they tell, that reveals so much. Keep asking those deeper questions. Because the cash flow statement, unlike the profit statement sometimes, it rarely lies.